Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing PDD stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 193 billion market cap. They're trading at $139 a share and they have 1.4 billion shares outstanding. PDD is a Chinese online retailer, but their focus is on the agriculture business. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow was pretty good in 2020, 2021, around 4 billion. Then it jumped 88% to 6.7 billion in 2022. Then it doubled to 13 billion in 2023. Their growth is phenomenal. Look at their margins. They converted 38% of their revenue into free cash flow. Anything north of 20% is amazing. Net income is the profit or loss on the income statement. It's revenue minus expenses. And look at that growth. Negative 1 billion, a positive 1 billion, shooting up to 4.4 billion, then up to 8.4 billion. You rarely see growth like this. Revenue is the sales for the company, and that went up 4x from 8 billion to 35 billion. Revenue per share is $25. That's revenue over shares outstanding. Each share price costs $139. That's how you calculate price of sales. It's stock price over revenue per share. So $139 over 25 is their price of sales. So it's between a 5 and 6. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 300 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $265 billion. We divide that by 1.4 billion shares. And we get a calculated stock price of 191. They're trading at 139, so they're trading at a 27% discount. It's a buy according to the model. Their free cash flow projections were actually a lot higher than my model. I lowered it just to keep it realistic. But if this was a US company, they'd already be $1 trillion market cap. But it's a Chinese company, and Chinese companies don't go up nearly as much as US companies. There are 45 companies in the same industry as PDD, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't really spend much in CapEx, so they don't need to. They have hardly any debt. They don't pay a dividend. They probably will pay one in the next few years. They generate a ton of free cash flow, 13 billion, which is a lot more than Amazon relative to their market cap. You can tell it right here, 15, which is a lot lower than Amazon, but not as good as Baba. They rank third in market cap, a little behind Baba. And the reason they're getting close to Baba is because look how much they're growing. Their 5-year annual revenue growth rate is 79%. Baba, a respectable 21%, but not even close to PDD. They're growing more than anybody else. They're trading at 23 times earnings, 15 times free cash flow. And remember earlier we talked about the price of sales between 5 and 6. It's 5.6. Revenue 35 billion. 1/4 of Baba's revenue, but it's a lot less than JD.com. JD seems really undervalued. If you put $10,000 into the company 10 years ago, you'd be really happy at $57,000 today. That's a 35% annual return. But at one point, your $10,000 would have been about $75,000. Let's take a look at their 2023 financial results in a little more detail. They report in Chinese yuan, 89 billion for 2023, which is 12.5 billion US dollars, up 123%. Operating profit, 3.2 billion US dollars, up 146%. Net income, 3.3 billion, up 146%. Their fourth quarter revenue was 12.5 billion. If you annualize that, it's almost 50 billion US dollars. For the whole year, it was 35 billion. Their biggest expense is marketing, 11.5 billion, R&D, 1.5 billion, G&A, 500 million. Operating profit for the quarter, 3.2 billion. For the year, 8.3 billion. Net income, 8.5 billion. In 2022, they had 5 billion shares outstanding. Now they have 5.4 billion. So they are adding shares because they're still growing, acquiring other companies. Here's a breakdown of the 35 billion of revenue. 21 billion is online marketing services, transaction services. That includes transaction fees, 13.3 billion. Let's look at their balance sheet. Current assets, $41.5 billion. Current liabilities, $21.5 billion. So their current ratio is about a 2. They have a lot of cash and short-term investments on their balance sheet, almost $40 billion. Total assets, $49 billion. Total liabilities, $23 billion. Assets minus liabilities equals equity, $26 billion of equity. They raised $15 billion from selling their business. They profited $11 billion from running their business. Let's take a look at the stock on Simply Wall Street. Its last price, $146, $200 billion market cap, up 7% in the past week, up a whopping 140% in the past year. Let's see what they say about the company. PDD is a multinational commerce group that owns and operates a portfolio of businesses. They offer Pinduoduo, an e-commerce platform that offers products in various categories, including agricultural produce, apparel, shoes, bags, mother and child care products, food and beverage, electronics, furniture, household goods, cosmetics, sports, and various other products. They also have Temu, an online marketplace. It focuses on bringing businesses and people into the digital economy. They used to be known as Pinduoduo, changed their name to PDD Holdings. They were incorporated in 2015, based in Dublin, Ireland. Here's the stock price since they started trading. They started around $20 a share, then got close to $200 in 2021. 2 years ago, it fell to $25. I was looking at this stock. I was really tempted to buy it. And now look at it. It went from 25 to almost 150, 6x. Simply Wall Street's at $324. They say it's 55% undervalued. 39 analysts priced the stock at $182. They say it's 25% undervalued. Their revenue forecast for 2026 is 580 billion yuan. Free cash flow, 156 billion. If you want to know the numbers in US dollars, just divide by 7. That's over $20 billion US dollars in free cash flow. They had only $500 million of revenue in 2016. That's in Chinese yuan. 1.7 billion in 2017. 93 billion in 2021. And now it's up to 250 billion. This red line is their debt. The blue line is their equity. They have very little debt relative to their equity. They're a really healthy company. 35% of the company is owned by institutions, 32% by insiders, 19% by the general public, and 14% by public companies. The company founder owns 32%. The Chinese gaming company Tencent, 14%. And then you can see a lot of funds and big companies own the stock as well. Look at their employee count go up from 1,000 to 17,000. And the ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.